Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video we are going to look at another 5 companies that are fairly valued according to Morningstar. Morningstar is this website that I use a lot, and the reason I use it is because, like I've always said to you guys, I feel like it does give me as an investor some sort of a margin of safety. There are other websites, for example, Seeking Alpha and others, where they use analysts. So what they do is they get analyst opinions, or different banks basically say, okay, this stock is going to go up this much or it's going to go down this much, and then they kind of average it out and they give you that price. Whereas Morningstar actually uses their own discounted cash flow model to come up with some sort of fair value for this stock for that year. And that's really important because, you know, they're not just taking someone else's opinion, they're doing their own due diligence. And then you can do a bit more research on the company and do your own discounted cash flow model on top of that, potentially, or have some sort of a margin of safety. For example, I normally tend to have about 5%, 10%, 15% of margin of safety on some of these companies. So what I want to look at today is 5 different companies that are currently fairly valued, meaning that they are the price they should be, more or less. Okay, so they're not cheap, they're not expensive, they're where the company that basically thinks they should be. So, and right now these companies, you might want to have a look at them and then decide to add to your watch list with a bit of a margin of safety. And then when you get the opportunity and when it hits your price target, of course, you know, buy them, and if that's what you want to do. But as always, just take this as a some sort of a bit of entertainment and do your own research, of course. But before we do that, of course, like the video, subscribe to the channel, and let me know if you have any questions. Of course, it doesn't cost you a penny to like the videos, and there are right now about over 50% of you guys that watch on the videos regularly are not really subscribed to the channel. So that would be really helpful if you could do that, because that goes a long way. As well as, of course, you can join us on the Patreon account, where you get access to the dividend and trackers, you get access to the watch list, you get access to all the buys and sales that I'm making on the Discord as well. So the Discord is where a lot of brothers actually sharing good practices on weekly days, you know, daily basis, weekly basis, and of course you can join us on that. And of course, try it out for a month, see if you like it. If you of course don't like it, then of course there's no problem in, you know, just leaving it out and get your spreadsheets, download them, halas, and that's the end of it. Right, let's have a look at the 5 companies. I want to make this video as short as I possibly can. Again, we look at the same things that we normally look for. So we want to see how big the company is. Do they have a economic moat, meaning this company, can they actually protect their earnings from others taking, you know, in terms of like competitions and so on. We're looking for the current price, we look at the dividend yield, we look at the payout ratio. We want to see the payout ratio because we don't want to buy companies who's paying a lot of their net income as a dividends, because we wanted these companies to increase that dividend. So we want to see what the latest increase was. We want to see the 5-year average for that basically dividend, and then dividend streak, how long the company has paid. We want to see how much they're paying, the safety according to Simply Safe Dividend. We want to see the margin of safety, return on equity, and return on invested capital, which kind of helps us to see how, you know, the profitability of the business, as well as, of course, how well the management is using the capitals that we give and reinvest in that to create more cash for us. We want to see the free cash flow. We want to see total, like I've always said to you guys, free cash flow is very important because that's the money they use for dividends. They pay back any, you know, pay off any debt that they have by other companies, you know, increasing their, you know, in terms of the reinvesting in the business, if you like. All of these things are basically comes from that free cash flow there. Total return in the last 10 years. I want to see how profitable this company has been in the last 10 years, how much cash it has returned to the investors. So total return includes price appreciation as well as the dividends. Growth estimate for the next year. So based on the analysts, we want to see how much they've actually expecting this company, the earnings to grow. On top of that, we also want to see for the next 5 years. And then we will look at the Morningstar valuations, which I've already said, every single one of these companies is fairly valued, and we want to see their fair value prices, inshallah. Okay, right, let's have a look. The first company is a software company. This is Robot Technologies. Currently has about 60 billion market cap. It has a wide economic moat. Current price is $549 per share. Has a dividend yield of 0.55, payout ratio of 16%, and latest increase was almost 10%. They have 5-year growth rate of 10%, which is quite nice, and dividend streak of 31 years. So this is a dividend aristocrat. Dividend aristocrats are companies that are in the S&P 500, as well as increase their dividend for 25 years or more. 50 plus is dividend kings. $3 is what you will get for every share of this company that you own. Safety is 98%, profit margin 22%, return on equity of 8%, return on invested capital of 7%. Free cash flow right now is $1.9 billion. Total return the last 10 years, we're looking at about 16%. Growth estimate next year, 9%, then 8% every year after that for the following 5 years. Morningstar valuation is a fairly value right now. $560 per share is where they think the price should be. Right now it's about $550, so not far off. And the next company we look at is NXP Semiconductors. Before we look at that, I just want to show you very quickly the based on Seeking Alpha what this company is doing in terms of revenue side of it. So you can see right now this is where we're at 6.18, next year 6.87. so the revenue is increasing, going the right direction, and basically Wall Street is actually saying is a buy, about 8% upside from where we are right now. So the next one, NXP $61.3 billion right now. Narrow economic moat. Price is $243 per share. Dividend yield of 1.67. Payout ratio only 29%, which is quite nice. Latest increase is 20%, and the 5-year growth rate of 50. That cannot be it. That is ridiculous. Okay, let me just double check this. Let's check this. 20% and 52%. Wow, that's ridiculous. Okay, so 52% in the last 5 years, and the dividend streak of 5 years. So they've only increased it for the last 5 years, basically. Annually, you will get $4.06. Safety 60%. So that spot right now, as you can see there, that color, so the borderline safe. So 61 and above is safe. So is that borderline right now? Profit margin 21%, return on equity 34%, return on invested capital of 18%, and $2.5 billion of free cash flow right now. Total return in the last 10 years 16%, 14% for growth estimate for next year, and then 9% after that. Fairly valued, like I said at the beginning, $240 per share is where they think the price should be. And looking at the analyst expectations, okay, you've got 11 strong buys, 5 buys, and 13 holds. And as you can see, the price right now is flat. In terms of revenue side of it, let's have a quick look and see where this company is heading. Okay, so there is a bit of a decline. So 13.28 to $13 billion. Then it bounces back about $14 billion. And same thing probably goes for the revenue for EPS as well. Next company we're looking at today is the one that I own in my portfolio. That's Linde, $217 billion. Has wide economic moat, $445 billion. Let me check something. Yeah, I wanted to check if this company, because I do know some of these companies do not have a economic moat that's wide. Okay, so this is the narrow, so correction. $445 billion, dividend yield of 1.15, payout ratio 35%. Latest increase was 9% and 9% in the last 5 years, which is quite nice. Dividend growth streak of 31 years. Again, another dividend aristocrat. Annual payout of $5.10. Safety 99%, 18% profit margin, return on equity 15%, and return on invested capital of 14%. Very, very solid, and $5.5 billion free cash flow right now, 14% in total return in the last 10 years. Growth estimate 11% for the next year, then 10%. Fairly valued, $398 per share is where it should be. Right now, slightly higher than that. It's okay, 445. Okay, so it's heading towards basically 2 stars rather than 3 stars. And looking at the revenue side of it, as you can see, from $32.85 billion to $34.37 billion, and then to $36.42 billion. And as you can see, the EPS is also heading the right directions from 14 to $15.54. And in terms of the ratings, okay, Seeking Alpha It actually says a strong buy. So the analyst in Seeking Alpha is saying a strong buy. Wall Street is actually saying a buy, and Wall Street is about 1% flat right now. So it's basically where they think it should be. Next company we're looking at today is Thermo Fisher Scientific. This is one of the companies that we've talked about quite some time in the last few months. I was very close to actually initiating a new position, but it gone up quite a bit at the time. Right now it seems fairly valued again. So $215 billion market cap. It has a wide economic mode, $561 per share right now. Dividend yield of 0.28, so non-existent, but at least nevertheless is there. Payout ratio 6%. Latest increase was 11%, which is quite nice. 16% in the last 5 years, and dividend yield of streak of 6 years. Annual payout, you get $1.56 for every share of this company that you own. 72% in terms of safety, which is quite nice. Profit margin about 14%, return equity about 13%, and return on invested capital about 9%. $6.9 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 17%. Growth estimate next year is about 12%, then 5%, 7% after that. Fairly valued, $600 per share is where they think the price should be. And looking at revenue and EPS, as you can see here for the expectations, right now it's 42.8, next year is 43, and then it's gonna go up again. So in terms of revenue, no issues from that side of things, and in terms of EPS is also heading the right direction. In terms of valuations from according to the Wall Street, okay, they are saying it's about 12 of them are saying it's strong buy, 6 buys and 9 hold. No sales there, but 6% upside from where we are right now. And final company we're going to talk about today is Hershey. This is one of the companies that I own. Almost a 40 billion market cap. It has wide economic mode, $190 per share, 2.88 dividend yield, 46% in terms of payout ratio. Latest increase was 15%, 5-year growth rate of 10%, 14 years of increase in that dividend, and $5.48 of that's what you will get for every share of this company that you own. Dividend safety of 93%, which is quite nice. Profit margin, do you know what, let me just check something. I just want to see if what they pay is, wow, okay, $5. I thought it was $4 something. That's interesting. $5.48, safety 93%, profit margin of 16%, almost 17%, 50% of return on equity, 26% return on invested capital, and $1.55 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 8%. Growth estimate next year, 7%, then 6%, fairly valued. $193 per share is where they think the price should be. 97, sorry. 190 it basically is where it's at right now. Before we finish the video, let's have a look at the from Sharia compliance side of things. Zoya updates quarterly, so some things sometimes do change, so bear that in mind. But since they've updated last time, this is where these companies are. I would not have basically any issues with any of these companies right now, as all of them are basically Sharia compliant according to this app. Again, you can always verify and you do your own research, especially with the these two sections. You can easily do that. The business activity, you can also look at the revenue side of it, look at the breakdown of their revenue, and see if they have any sections or segment within their business that is more than 5% that's deemed to be non-Sharia compliant. And if that's the case, of course, then you need to do what you need to do. But according to Zoya, it is actually fine when it comes to that. There you have it. That's the 5 companies I wanted to share with you guys. It takes a lot of time to put these videos together, so I'd really appreciate it if you can like the video, and please subscribe to the channel so you don't miss out any of the videos that we produce, inshallah, moving forward. And of course, as always, join us on the Patreon account. Really appreciate your support. Thank you very much. Assalamu Alaikum.